as many of you know, every time I talk about central banks, I get quite passionate and quite emotional. For me, I just don't understand how central banks can continue to raise interest rates time and time again. I know Federal Reserve took a pause last meeting. It is highly anticipated that the Fed will raise rates 1/4 point at 2 p.m. this afternoon. So I guess in just under 2 hours from now. And then we're not sure what's going to happen in September. We're hearing that it is a live meeting, which means anything can happen. They could raise, they could pause. Some people think that they're in this sort of pattern where they pause, then raise, then pause, and then perhaps raise again before the end of the year. We saw Bank of Canada go on a pause themselves for a few meetings. And then recently they've raised rates the last two meetings. So, where are these central banks going? What is the end game here? It's very difficult for, I think, individuals to understand what's happening. They're seeing their costs rising, the cost of borrowing money, the costs of maintaining or carrying those loans that they may have, whether it's a mortgage on your home, a line of credit for your business, or whatever it is. Those costs are rising. And in fact, as I've said many times on this show and radio show, a lot of people getting letters in the mail talking about or asking or demanding by the banks that individuals that have a mortgage pay more on their monthly payments. No longer are people able to say, okay, well, just pay less principal and more to interest. Well, right now, with interest rates rising as fast as they have and as much as they have, people's payments aren't even covering interest any longer. And I know the average person out there, at least from what I've heard, they've received a few notices saying that their mortgages or their mortgage payments has to go higher once again. So it's difficult, right? It's difficult for people to understand. And for me, one of the, I guess, things that I get most bothered by is when you hear the comments made by Federal Reserve governors, Bank of Canada, when they say, well, the economy is still too strong, or the economy is so strong, it's so resilient, it's doing so well. It almost makes it sound like that's a bad thing. And so they make those comments, and then they say, well, that's why we have to raise interest rates to cool off this economy somewhat, to bring down inflation. Well, in my opinion, the economy is doing well, relatively speaking. It's definitely slowed from where it was a couple of years ago, but you can actually have inflation come down and the economy continue to do well. You can have inflation come down and have jobs growth. We're seeing this over the past year or year and a half. We're seeing inflation drop quite substantially in our country from 8% down to 2.8%. And as we know, Bank of Canada wants a 2% rate. And in the US, it's down from 9% to 3%. That's a big fall and a big drop. And for those that thought this was going to happen quicker, I don't know why you would have thought that. But to say that the economy is too strong, and so that gives the central banks the opportunity to raise rates further, I think is just ridiculous. We want a strong economy. We want people to have jobs. We want retail sales numbers to look good. We want housing to be strong. We don't want these things to fall. And that is the risk, obviously, that these central banks are taking when they continue to raise rates. They continue to have this mentality that as long as things are strong, we're going to squeeze in more and more rate hikes until perhaps something cracks. Well, maybe we did see a crack in the economy early on this year when there were some bank failures out of the US. I think it was due to the quick rise in interest rates in the US. So in my opinion, I think things have already shown some cracks in the economy, but overall, a definite slowdown. And let's just go through some of these charts. The first chart we have here, we have the federal funds target rate since 2006. You can see on the far right-hand side how quickly interest rates have moved higher. That's pretty much a straight line up. And we're kind of in that range where we were back in 2000, let's call it 2007, 8, back to above 5%. So it's not that the rates are in at around 5%. In my opinion, it's all about how quickly we got there, or the US got there. And we're going to see a chart shortly to show how quickly the Bank of Canada got there as well. And I have another chart here showing US Consumer Price Index. You can see here that the core inflation rate, 4.8%, the headline number at 3%. And really, it's the core rate. It's the core rate here in Canada as well that these central banks are concerned with. Core rate here, about 4%-ish. In the United States, about 4.8% when you strip out volatile energy and oil. I don't know how you do that. As I've said many times, oil prices and cost of energy seeps into everything. If you're transporting goods or commodities or even services, it definitely plays a factor. So it's hard to pull that out when you have a number. But if you were, it's 4.8% in the US. And you can see the next chart, we move over to Canada here, their overnight interest rate versus the inflation rate. Again, we've seen this chart on this show before, and you can see such a large gap, a 5% Bank of Canada rate and a 2.8% inflation rate. And I was actually asked this question over the weekend on the Sunday Money Show. What does this mean? Well, I think it means that if things should turn down, that we could see, or at least the Bank of Canada has enough wiggle room there to actually lower rates come 2024, whenever they decide that they can do that, if they need to stimulate the economy. But make no mistake, central banks over the past, I guess, many months now have indicated that they're not interested in lowering interest rates, at least for the time being. Here we have the next chart we have, an annual interest rate, inflation rate in Canada, I should say, and how it's broken down into many different types or many different areas. You can see mortgage interest costs. That is the highest. Food prices, that's up 9% year over year. You can actually look at all the other items and you can see the 2.8% inflation rate there. And interesting enough, if you look down, you see gasoline. Gasoline prices have come down quite a bit and now show negative percentage there. So that goes a long way to offset some of these other higher costs that the others bring. I think the last chart, or one of the last charts we have here, I believe that, yes, it is the last chart. We're going to show the rate hike cycle by the Bank of Canada. So we saw earlier chart showed how fast rates went up in the United States. Well, let's take a look at Bank of Canada. Look how fast that red line has moved higher, pretty much higher than any other point in time in recent history, at least going back as long as I can remember. And again, it's not so much where we are at today. It's about how we've gotten here. And there's been some rumblings that Bank of Canada might now be on pause. You know, we've seen headline numbers with a 2 in front of it, 2.8%. Maybe it's time that Bank of Canada pauses and maybe has a little more patience. And that, you know, should go maybe for the Federal Reserve as well. Let's take a step back. Let's show some patience, and let's see where inflation goes in the coming months. And hopefully we don't get a tick up. And if we continue to get ticks lower with respect to inflation, and if we can keep jobs data or jobs numbers strong, I think that's a recipe for success. I'll take a 2.5%, 3% inflation rate with full employment. And make no mistake, the mandate of these central banks is twofold: full employment and price stability. Just seems like central banks are only focusing on price stability these days and not on full employment. So we'll see what happens at 2 p.m. today, and we'll see what happens with the Bank of Canada as we get closer to the next rate decision that they have.